Hey guys, how's it going? Lewis Harding Investor here. Welcome back to my channel, and in today's video I'm going to be analysing Games Workshop stock. I'll be using fundamental analysis to see if the business is worth buying or not. I'll then be using a DCF valuation to determine the fair value of their stock. Let's get straight into it. Who are Games Workshop? So Games Workshop Group plc is a British manufacturer of miniature war games, and the company is based in Nottingham, England. Its best known products are Warhammer Age of Sigmar and Warhammer 40,000. So it was founded back in 1975 by three guys, and the company was originally a manufacturer of wooden boards for games including backgammon. It later became an importer of the US role-playing game Dungeons & Dragons, which I'm sure a lot of people will have heard about. It expanded into Europe, the US, Canada and Australia in the early 1990s, and yeah, it started promoting games associated with Lord of the Rings in 2001, and it also owns Forge World. And yeah, the company is listed on the London Stock Exchange and they're a constituent of the FTSE 250 index. Now let's have a look at the sales summary for the business, and there's not much of a breakdown here, but anyway, let's go with it. So the trade makes up 55% of sales, online make up 25%, and retail make up 20%. Sales per region, the majority of their sales come from North America, with 41%, continental Europe makes up 23%, the UK makes up 23%, and then the rest is made up of Australia, New Zealand, Asia, and then the rest of the world. So let's have a look at the income statement for Games Workshop, and all of this data has come from Morningstar, and from 2017 to 2021 the turnover has more than doubled, which is obviously phenomenal. Very good stuff. But what's also very impressive as well is in that time the profit has quadrupled. So they have doubled their revenue but quadrupled their profit. That is unreal. Great stuff from Games Workshop. Now onto the balance sheet, and the main two figures I look at when having a glance at the balance sheet. The first figure is long-term debt. So we have a look at the liability section. Let's go to the non-current section, and yeah, there's not much debt at all, let's be totally honest. Over the past couple of years they've introduced a very small amount of debt, 31 million and then up to 41 million in 2021. But yeah, very good debt wise, not much debt going on at all, which is awesome to see. And then shareholders funds, also known as shareholders equity, that has been growing as well for the past 5 years. Not surprising with the amount of profit they've made, but yeah, awesome stuff. So yeah, now onto the cash flow statement for Games Workshop, and yeah, I can't calculate free cash flow from here, but operating cash flow will have to do. And yeah, since 2017 it has been, rising rapidly, and it's not quite gone up 4 times, but it's gone up a hell of a lot in a 5-year period. So yeah, not much to say on this one other than very good growth. Now let's have a look at the key financial ratios. So this is a little bit different to macro trends because this is Morningstar, of course, but let's have a look at the profit margin in the profitability section, and yeah, you can see that over the past 5 years they've been increasing profitability, which is awesome to see. So they've been growing the revenue. So they've doubled the revenue in 5 years, they've quadrupled the profit in 5 years, and they're increasing the profits as well. There's no wonder this business is one of the darlings in the city over the past 5 to 10 years. Return on equity is phenomenal as well. Awesome stuff. Then going on to the financial health section, and gross gearing is, like I said before, it is really low. 24% gross gearing across the full business. That is really good stuff. And then having a look at the quick ratio, also a lot of liquidity going on in the business, so awesome stuff from Games Workshop once again. Right, so let's have a look at the genuine impact stats for Games Workshop, and we will start with the quality metric, and I must say this is one of the highest scores I've seen in a while, a score of 273 out of all of the genuine impact universe. So yeah, profitability very high, financial strength very high, and capital allocation very sound. So overall, a very strong business financially. And yeah, I must say I've been extremely impressed with them. Value wise, unfortunately, it's looking a little bit expensive. A forward PE of 29, and I do know the PE, I think it's higher than that. It might be lower, we'll see on my analysis next. Anyway, income statement and balance sheet are looking expensive, but then cash flow is looking medium. So I would just say it's probably looking a little bit on the expensive side, to be totally honest. And then yeah, looking at the growth metrics, as you've seen from the previous figures, it's all very high and they're growing earnings and sales and everything at a high rate, so really, really good to see. Now onto my analysis checklist or Games Workshop, and the stock is listed in the UK on the London Stock Exchange. They've got a market cap of £3 billion, and the current price is, as of recording, it was £96.55. And then yeah, PE ratio of 26, so it's actually lower than the forward PE. And then yeah, let's have a look at the metrics. So profit margin wise, they absolutely smash out the park, and yeah, very, very impressive stuff, especially that bottom line net margin, 27%, awesome stuff. Return on equity is also extremely high. That just shows how much of a quality business they are. And then yeah, long-term debt to equity, this is actually the total debt to equity, so the total gearing of the business is only 24%. So yeah, and this debt's only been taken on recently. Yeah, current ratio, very solid as well. Proven ability to grow, everything's in the green, not surprising from, you know, what we've seen in the previous financial figures. Great stuff. Great capital allocation. The long-term debt repayment should be red. I got that wrong there because they have issued £41 million of debt in the past 5 years. Not a concern, but that one should have been in the red. I missed that one out. Dividend growth, yes, that's been growing. Shares have been decreasing, and a few decent acquisitions along the way. You know, they are great allocators of capital. But unfortunately, like many a stock at the moment, buy at a fair price. It fails this pillar. A PE ratio of 26 and a price to free cash flow ratio of 31 is looking a tad steep. Yeah, so for a 10% return, I'm looking for a share price of £69, and to the current share price, you know, shown on here, it would be a drop of 28%. Let's have a look at my DCF valuation and how I got to my figure of £69 per share. Now onto the DCF valuation for Games Workshop, and my free cash flow figures have come from Market Screener, all from analyst estimates going into the future, and with a required rate of return, and I have added the cash balance onto the business because I've got a net cash position. I'm showing a share price of £69 per share for a 10% return. So yeah, it's got a little bit to fall, but it was below the share price around a year ago, I believe. So yeah, anything is possible in the stock market. So what are my thoughts on Games Workshop? So I think you know what I'm going to say, but the company is absolutely phenomenal, very profitable, high returns on capital, very, very low leverage. But unfortunately, it's just a little bit overpriced at the minute. If the share price declined by 20-30%, I think that's when I would start to get interested. There is no doubt, and no one could say this, that Games Workshop is not a fantastic company. The financials just show this completely. You know, revenue over the past 5 years has doubled. The profit over the past 5 years has quadrupled. Cash flow growth has, you know, gone up 3.5 times. This is just outstanding stuff. A very, very low amount of leverage as well. I think this shows this company does have a moat, let's be totally honest. I'm going to do more research into this stock myself because I don't really get Warhammer or anything like that, but I do get profit and I do get cash flow, and this company spits out a lot of it. So yeah, for now I will probably add this to the watch list. A 28% drawdown to get to my favoured share price is not beyond the realms of possibility. These things happen in the stock market every now and then, and if it does, you have to take advantage in pounds. If you enjoyed today's video, please subscribe to the channel. Thank you very much for watching. I will see you next time. Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.